Have you ever wondered how exactly is the sausage made? And by the sausage, we're talking mortgage interest rates. We all know that the Federal Reserve does not dictate mortgage interest rates. There is an entire secondary market. In fact, in today's episode, we're going to demystify it, not just for loan originators and mortgage brokers, but also for home buyers and real estate agents. I went out and found a special guest who's been doing this for 15 years. He works for one of the top companies in the mortgage industry. And this entire episode is all based on demystifying the secondary markets, or better yet, teaching y'all exactly how the sausage is made. Check this out. Ladies and gentlemen, boys and girls, children 18 plus, you are tuned in to the Loan Officer Podcast with me, Dustin Owen, and a very special guest. This guy originally is from Pennsylvania, where he went to Penn State. Today, he lives down in the DMV. Coming out of college, this guy once had to teach the U.S. Treasury how to balance their books and pay their bills on time. Today, he's an executive at Optimal Blue. He is my new friend. He is today's special guest, the one, the only Mike Vough. Mike, welcome to TLOP.
Thanks for having me, Dustin. That's a hell of an intro.
Yes, thank you. That's kind of my shtick. That's kind of my thing. I'm excited to have this. I'm excited, to like build a friendship with you, but also to build a partnership with OB, because I think companies like OB need to be spending more time in the trenches with loan originators and mortgage brokers and VPs of lending. And this may just be the avenue or the first steps that we need.
Agree with that. At Optimal Blue, historically, we were very focused on capital markets, working with lock desks, working with heads of secondary. And in this last, let's call it 9 months or so, we've spent some time trying to get more in the trenches, right? There's a lot that we could benefit from as a company, but also hoping to provide some of our value to people on the front lines and help demystify some of these things that happen in the capital markets and bring it to the origination side of the house.
So if you're a loan originator, or you're a home buyer, or you're a real estate agent right now, what are you hoping to deliver over the next 25 or 30 minutes that they're going to be rewarded by tuning into you and I?
Yeah, for the loan originator or the real estate agent, we want to help them understand what's going on in the market so that they could better educate their clients, so that when rates change, they know how to answer the question, should I lock? Should I float? Should I do this? Should I do that? So we want to help those folks. And on the more of like the consumer side, just starting that journey of understanding the feedback loop between what happens when Jerome Powell speaks, when the head of the Treasury does something, and how does that impact what the consumer sees from a rate perspective. And some of these lessons I think will hope to extend outside of mortgage, just to general personal finance, right? When the Fed changes rates, it's not just mortgages that change, it's your credit card, it's your auto loan, it's potentially the rate on a HELOC, right? These things all have ramifications from what happens in the capital markets. And
as we've seen in 2025, when the Fed changes their rate, it doesn't mean mortgage rates change in the same direction, right? We are 3 for 3 this year. Federal Reserve changing their rate, yet mortgage rates go in the opposite direction, meaning the Fed lowers and mortgage rates shoot up. I'm sure we'll probably get into that. I mean, you and I both know that is normally because the mortgage market has already priced in what they think the Fed's going to do. And after the Fed does what they do, they then comment, and that commentary then forces the market to go back and trade, and they tend to trade in a more scared or conservative approach than what they were anticipating. But that may be for later on in today's episode. Before we dive into it, shout out to our sponsor. Today's sponsor of the show is Lower Mortgage. Shout out to Lower. Yes, they reached out and they said, look, we are on a mission to represent mortgage lending of the future. We're already a top 25 lender. We're already funding $500+ million per month. We feel like we are on a mission to become the most respected lender in the country, a top 10 lender in the country, by helping our branches and our originators become top 5 in each of their markets.
That makes sense.
They're going to dominate traditional networking, online networking, and creating a work environment that is tech-enabled, future forward, and one of the best places to work. So if you're ever interested in learning more about Lower, and you don't want to take John's word for it or my word for it, okay, they make it super easy. They offer a no pressure, anonymous, no questions, hop on and let us present to you why we are doing what we're doing, where we're trying to go, and help you kind of look under the hood without being recruited. Look under the hood without the sales pressure and all that comes with like being recruited, that sometimes if we're not ready for it can be a little bit icky. So if you're ever interested in being included in one of those calls, I believe they call them Lower Launchpad. All you have to do is reach out to my guy, Connor Bartley, over at Lower. His email, cbartley, that's CBARTLEY at lower.com. Connor can make sure you get invited to the Lower Launchpad. You won't be sold, you won't be recruited, you won't see your face, and no one will know that you're on the call, but it gives you an opportunity to look under the hood. I would like for the people to get to know you a little bit better. So you are from Wilkes-Barre, Pennsylvania. We were talking about that back in the green room. It's crazy because like one of the TV stations you grew up watching was one of my first clients when I worked in TV advertising, WBRE. So shout out to, I don't even know if WBRE is still around, is it?
Still exists, yeah.
It is, yeah. Wilkes-Barre, Pennsylvania. I once worked at WFLX in West Palm. That station doesn't exist anymore. Or if it does, it's no longer a Fox affiliate, and it's now like an independent Univision or something, that's not one of the main networks. But you're from Pennsylvania. You live now in I say the DMV, but the DC metro area. And you once worked not for the Treasury, but you worked like as a consultant in the U.S. Treasury.
Correct.
So walk us through that. How does a guy who does what you do for a living, like what was your background coming out of school? What did you study?
Yeah, so I'm going to take this in a little bit different path. So I got started in the finance journey actually when I was doing a summer job in high school. I worked at a book packing plant. So
book packing, like before Amazon.
So before Amazon. Well, Amazon was there, but not the scale it was today.
Okay.
So think about like, you order from Barnes & Noble online, and then you get a package in the mail that has the 3 books that you ordered. I was on an assembly line, and I would get a ticket, and then you have to run and then go find the books before the box got past you on the line. And this is like my parents' way of trying to like teach me like, hey, get up, go to work, a real job, etc. So I was 17, and I needed the money for my car, saving up, whatever. And I would get up in the morning around 5 a.m. to go to this job. But there was a lot of dead time on the job, and so I read Michael Lewis's books, Liar's Poker, and I read The Big Short.
So by the way, Michael Lewis is one of my favorite authors. If you can pick up any Michael Lewis book, right? Yes, Liar's Poker is really good. The Big Short is really good. Liar's Poker was first. Big Short was second. Though those events were probably about 2 decades apart, but very similar. But he also wrote Moneyball, right? And Moneyball changed the way that Major League Baseball operates. And he obviously didn't invent Moneyball, but he was the author behind it. Okay, so you're working in high school, have some downtime, and I'm guessing you have access to like all these.
You have all these great books.
Yes.
So I when there's not a lot of business coming through this assembly line of taking a book off a shelf and putting it into a box, you'd read. So I read a ton of books that summer, and I read those 2 books and was like, I need to be in finance.
So you knew at 17, graduating high school, heading off to Penn State, go Nittany Lions, although you're having a really rough year this year.
Onwards and upwards from here.
Onwards and upwards. I mean, where else are you going to go? Sidebar. So Franklin's out, right? Do you have a coach in mind?
I have a couple.
You do?
Yeah. So,
as an alumnus, I mean, I'm sure they give you a big vote.
Yes. As somebody who's bought a couple T-shirts, I've got a big say in the decision. I really like the coach from Arizona State. Kenny Dillingham.
Yes.
I really like him, and I also like the coach from Missouri. Eli, I can't say his last name yet.
Yes.
Dinkowitz or something like that.
Okay.
I really like those guys. I'm happy that Urban Meyer's kind of out of it. They said this weekend that Urban Meyer's off the table.
Okay.
So that's good. But anyway,
Yeah. So back to you go off to Penn State to study finance, but it was because of these 2 books.
Because of these 2 books.
Okay.
And then as I was going through my career at Penn State, I saw a job for consulting down in Washington, D.C., working on big government projects. And I was like, that could be interesting. And I actually just watched the show on HBO with Don Cheadle when he was a consultant. And he made the lifestyle sound really, really cool.
Okay.
And so I was like, okay, let me get off the markets, and I'm going to do consulting, and it looks really cool. And I went to Washington, D.C., and I learned a lot of really awesome stuff, but it was not as cool as it was portrayed on this one TV show.
What did you like least about being, I mean, it's interesting. You're 22, 23 years old, and it's like, what are you going to consult? who are you consulting at 22 and 23? And then, yeah, what didn't you like about it?
Yeah, I think it was an awesome, like, I call it almost like a finishing school.
Okay.
So I got fantastic at Excel and fantastic at PowerPoint, and I learned how to write good emails, and I learned how to, like, write a memo. So it was like things that you kind of don't learn in school that were, I think, really impactful later in my career to get, like, that finishing school piece. The part of it with consultants, though, is that you can dream up these great big things. You could even implement them to a certain extent, but there was that last, like, mile that they don't really have a say in, and you pour your heart and soul into something, and then you wouldn't, like, get it across the finish line. You get it 3/4 of the way there, and you kind of, like, disappear, and you come back and you're like, hey, how you doing?
Yeah, because it's not your company.
It's not your company.
It's not your money.
It's not your money.
Yeah. So you're relying on other people to execute on your ideas. But you do get to have great ideas and be a visionary, hang out with a whiteboard,
Yes.
do some spiraling, as we call it at TLOP. Like, I actually have a day every Friday afternoon, so after lunchtime, my two partners and I, and we invite some of our coaches to be a part of it, and we invite some of our associates. We'll just spend 2 or 3 hours spiral sessions, where that's the fun part of the week, where it's all innovation and it's all visioning. It's like, where do we want to go next? Who do we need to be talking to? But as a consultant, I guess the fun part was you got to kind of do that. I love how you put it. It was a bit of a finishing school, but it got frustrating because at the end of the day, you weren't the one funding the actual project, and you weren't the one that got to see it all the way through. Those employees did, and they would typically get about 2/3 of the way complete, and then they'd give up on the project.
And there was a little bit of, like, herky-jerkiness to it too, right? Like, there'd be like, oh, work around the clock for this one project with this deadline, which the deadline, did it really matter if we hit it or not? I don't know if we did, if they didn't adopt anything.
Yes.
So, like, and then there'd be, like, times of downtime, which I think what I really appreciate about my next role, which was I moved over to Compass Analytics, and I got back more to the markets.
Yeah.
And so I started over there as a TBA trader, and that was lock in, right? Like, and you think, like, equity markets, like 9 to 4, you're like, wow, that's, like, not that bad. But it's really on the fixed income side, it's 8 to 5. So when you're a trader on that side of the house, like, you're at your desk no later than, like, 7:15, because you want to see what's going on overnight. You want to read the news. You want to make sure that if you're managing a position, that nothing unexpected happened. And then you're, like, kind of dialed in, right? Like, you are staring at the screens, you're picking up emails, phone calls, and so it's like drinking from a fire hose for, like, 10 hours, and that's, like, that could really, like, drive some people a little nuts, but it's very stimulating.
So I'm going to slow this down a little bit. I'm going to rewind it.
Yeah.
So you leave the consulting job, and by the way, his consulting job I think would be so cool. Like, and the way I understood it, and we don't need to dive into it because that's not what this episode is about, but your company was hired by the United States Treasury Department.
Correct.
And the Treasury Department has to make sure that, the bills get paid over at the Department of Defense, and the bills get paid over at this other, government entity. And someone has to track the money, and someone has to balance that checkbook.
Correct.
But instead of balancing a checkbook with thousands of dollars, you're balancing a checkbook with billions of dollars.
Yes.
And just like when you balance your checkbook at home, which I know no one does this, but, like, bear with me. Back in the day when we were balancing checkbooks back home, I'd be like, wait a minute, I'm missing $20. Where did it go? You were missing $20 million or $2 billion and having to help them figure out, hey, where did the money go? Where's their leakage, or where's the accounting not totally in line to where it needs to be? Then you leveraged it to Compass Analytics. Now you're at Compass Analytics, which at this time serves the mortgage industry, right? Like, that's what they do. And what a lot of people don't know is that when you lock in an interest rate, you're not locking in anything. You're making a bet in terms of where is the market going to be 30, 45, or 60 days later. And I think that's, like, when we're talking about educating consumers and loan originators and realtors, I think that's what they have to understand. And in order for a bank, credit union, or a mortgage lender to be able to actually deliver, because when you say lock me in, as a consumer, we do lock you in.
Correct.
Like, meaning we commit to you in writing that we're going to give you this rate in 30, 45, or 60 days, regardless if that rate is profitable or if that rate's available in 30, 45, or 60 days. So in order to do so, we have to place a hedged bet, right? And the best way I understand hedged bets is this. I'm at the craps table, and I know, based on how I'm betting, if the number 9 hits, I'm going to make $1,000. Cool. But if number 9 doesn't hit, I earn nothing.
Mm-hmm.
So what could I do? Well, I'm going to bet $500 that 9 doesn't hit, at which point I'm locking in a $500 profit. Either way, I win, right? If 9 does hit, I make $1,000, but I also lose $500. Crap. If 9 doesn't hit, then I still make $500. I didn't make the grand, but I still made 500. And that to me is like the perfect way to understand a hedge, because people say, oh, you have to hedge your bets. Well, you hedge trades, and that's what we call a TBA. So your first stint out of being a consultant was working on a trade desk.
Correct.
And you were trading in TBAs, which is, do you call those futures? What do you call a TBA?
Yeah, they're technically a forward.
They're a forward.
Forward contract, yeah. It's forward settlement of a to-be-announced mortgage-backed security.
Okay, so which this is so confusing. Even like where I sit in my career, right? I've read the book Demystifying Secondary.
Mm-hmm.
I've done School of Mortgage Banking too. I've been to 2 MBA secondary conferences. I have my CMB. And when we still talk about
Too many acronyms.
what it really means to, none of them really pay extra money. They just give me maybe the confidence to speak a little bit more clearly. But when we talk about like it's a forward, it's a forward trade. So I'm buying something that doesn't exist, but I'm locking in the price today.
It's funny. You're actually selling something that doesn't exist.
I'm selling something that doesn't exist.
Yeah. So the way I like to think about it, and I think I've honed this explanation after years of trying to explain to my family what I do for a living. But I actually am going to take us off mortgage. It's really analogous to almost any other manufacturing process. So I typically use like farming as an example.
Yes.
So let's say that you're farming corn, for example, right? You plant the seed. And when you plant that seed, you think you're going to make $1 on that seed of margin, right?
Yes.
And
you're planting in the spring. You're not harvesting till the fall.
Exactly.
Okay.
You have to, but like the price of corn changes every day, right? There's corn future markets. There's what's happening in the grocery store.
Typically traded in Chicago, right?
Correct.
Yep.
And but at that moment in time, if you plant 1 seed of corn, what you might want to do, and you want to make that $1 of profit margin, you might then go sell a corn future that's supposed to basically expire when you think you're going to harvest that corn. And it's the same type of concept for mortgage banking. We're manufacturing mortgages, and we want to make the margin that we planned on day one, but we want to protect it against anything that's happening in the market, right? Let's say, Powell raises or decreases rates. Let's say that there's some type of, large macroeconomic event. There's a war somewhere.
China bombs Taiwan.
Exactly.
Yeah.
We need to be protected for things like that. There's a big job number, or there's no job numbers anymore.
Yes. Well, right now there's no job numbers, but let's say we start getting job numbers, and all of a sudden unemployment jumps from 4.1% all the way to 4.9%. That would be pretty devastating for our job economy. It'd be great for mortgage rates, except, if I had told someone I was going to lock them in at a certain rate, and yes.
Yeah.
Okay.
And in that case, right, like the borrower probably doesn't care, but they should understand what's happening, right? Like you're like, hey, I locked in this rate. What does it matter? Well, the mortgage entity that's like giving you this access to capital is impacted by what's happening in the secondary market, right? If they all of a sudden can't sell that piece of corn and make their $1, they're making 50 cents. Well, if that happens at scale and you're not hedging, right, you can't plan for the future. You may not be able to make harvest next year because now your profits is now down to break even. So there's all types of impacts there that could happen from that.
Yeah, I think what's important for the consumer, the loan originator, the realtor to understand is that, first and foremost, banks and lenders don't actually portfolio or hold on to that loan, right? So it's not like you're coming to us and we're saying, we're going to give you 6% and that's the rate. Like, no, like I'm honoring 6%, but ultimately the way that I stay in business and the way that I stay liquid is to be able to sell your loan, allow that loan to be packaged, turned into a bond, and then allow life insurance company and pension funds to purchase that bond, no different than they would purchase any other bond, whether it's a muni bond or it's a treasury, right? Those are all different types of bonds you can purchase, just like you can purchase stocks and mutual funds and so many other things that you can invest in. So it starts with understanding there's an entire market to the mortgage industry. And then when you come and you say, I want that that program. I want you to lock me in. My closing's in 30 days. We, as the lender, I can't deliver that loan until you close. But there's a 30 to 45 day gap between the day I honor that interest rate and the day that I have to deliver it to Wall Street, and a lot's going to happen. Or maybe nothing happens, but we don't know. And if a lot happens against us, then I need to have a opposite trade against the one I made with you. Because the trade I made with you is like, look, it's 6%. If rates drop down to 5.5 in the next 45 days and I close you at 6, guess what? I made a ton of extra money. Woohoo me. However, that's not the business we're in for. If you talk to any financial person, what they don't like is uncertainty. What they love is knowing what's going to happen, right? Like the markets do not like uncertainty. You can see what's transpired over the past 9-10 months and see how the market is volatile. It's volatile because we don't have certainty. Well, imagine this. I locked you in at 6, but the market gets worse. Inflation data comes out and inflation's red hot again, and unemployment data comes out, and we learn that actually unemployment dropped from 4.1 down to 3.5. And it's like, holy cow, we have a red hot inflationary economy. That's not good for mortgage rates. So if I promised you 6, but rates shot up to 7, I lose my rear end. And just like Mike said with his corn analogy, that's fine on one loan. That's not fine on 1,000 loans. So if I said I'm the lender, I'm not looking to make a bunch of money on you when rates go from 6 to 5.5 and I have you locked at 6. And I'm also not looking to lose a bunch of money on you when rates, I gave you 6 and they went to 7. Mm-hmm. I'm literally looking, just like that farmer was, I'm looking to lock in my profit margin. Everyone has profit margin, right? I don't care if you're a house cleaner. I don't care if you run a manufacturing company or a car dealership. We all are trying to achieve a certain profit margin. Like mortgage lenders, I would guess, we're all trying to make somewhere between all in. And I'm even talking wholesale guys. Like I know if you're a broker, you're only making $275, but I promise you, right? Look at their earnings, right? UWM and Rocket are still making money on top of your $275. So we're all trying to make 400 to 500 basis points or 4 to 5% on the loans that we generate gross, so that we can do what? Net 40 basis points, right?
Something like that.
40 on a great year, 80, right? And the past 3 years, negative 15. So like that's a little bit of what we're getting at, and hopefully I did justice recapping a little bit.
A second career here, if that doesn't work out.
If OB wants a partnership with T-Law, we can definitely work that out. You can roll me out, and I can be your little monkey that you wind up and let me go, and I'll start demystifying secondary alongside you, and I can kind of do like a Cagney and Lacey type, type duo.
And, another point I like to make though sometimes is it's kind of like the opportunity cost impact to an investor as well, right? So if you're holding that 6% mortgage rate as the mortgage company, and investors can see all these 7% mortgages, they would much rather go for the extra yield or the higher interest rate, and they're going to pay more for that in relation to your 6. So if if you're not hedged in that case, right, maybe you're going to make that 400 or 500 basis points, and now you're only making 200 or 300 basis points on that loan. You're very quickly at like flat.
Okay.
Break even. So that's what happens when you don't have the hedge. But when you have the hedge on, you're going to be guaranteed, with some like rub here and there occasionally, right, if there's extensions or renegotiations or anything like that. But generally, you'll be able to lock in that profit margin.
Answer this question for me, because as a loan originator, there's nothing more frustrating when I locked in a client at 6 and rates are currently at 5.75, and I need to extend the lock. Maybe, I don't know, the seller didn't sell their house and the buyer didn't sell their home, so now it's a domino effect, right? Buyer didn't sell their home yet, so we have to push out closing by 2 weeks. Now all of a sudden I'm going to my capital markets team as an originator saying I need a interest rate lock extension, and rates are lower today than they were. Why can't I just give the lower rate, or why do they have to charge money to either me or to my client for an interest rate lock extension? What's transpiring in the secondary markets that's keeping me from being able to drop the rate because the market's gotten better and they're making me pay to have that interest rate lock extended?
Great question. And this is a very common one. So what typically happens is when that lock is taken out, right? There's typically an expected lock end date or expiration date, right? And let's say it's 45 days. Well, what the people in capital markets are doing is they're going out and they're finding a security or a hedge that closely aligns with when that loan is expected to fund. So, they might sell, hey, I'll sell the TBA contract 2 months out, and that'll give me a little bit of wiggle room. Well, if at the moment you start extending that lock, what the capital markets team might be doing is they might have to go buy that coverage back, right? Remember, it starts with a sell, right? You're always long mortgages because you're originating mortgages every day.
Yeah, so I'm buying when the home buyer or the borrower wants to lock in.
You're selling.
I thought I was buying from them.
Oh, buying from them.
I'm buying from them. I'm like, yes, I will take your commitment.
Correct.
But then I have to go sell into the future market a opposite trade that allows me to lock in my profit margin.
Correct.
Okay.
But
like, it's a business. Like, there's a
Yes.
whole entire business happening behind just a broker telling a consumer, that's your rate, I can lock you in today.
Correct.
Okay.
But then if you change the circumstances, right? And let's focus on extension, right? Let's say you have to go out in our 30 days because they couldn't close, or they had to sell another house or something like that. The capital markets team has to go out and now buy back their original sell and then put on a new sell that is more closely aligned with the new circumstances of the loan. So if it's a 2-month out future contract, now they might need a 3-month out future contract. So they have to buy the 2-month and then sell the 3-month. And there's transaction cost along the way.
So essentially, those interest rate lock fees are covering
Correct.
the fees that the capital markets team is incurring because they have to, behind the scenes, manipulate and change their original trade.
Correct.
Okay, so it's basically one of those. I was taught this. One of my jobs in high school was I was digging ditches for a plumbing company.
Oh, wow.
Okay, and Vince was the superintendent, and Vince lived across the street from me. I was only 15 years old, and they paid $5 an hour under the table, so I took that summer job. And first day on the job, he hands me a shovel. He says, I want you to start at basically the garage, his new construction, and I want you to dig to the sidewalk. And I need you to progressively get a little bit deeper as you go. And I was like, well, why is that? He goes, well, I have 2 rules to teach you in life and in plumbing. Your boss is always right and shit flows downhill. True story. He's like, you start with 6 inches, you end at 6 feet because poop travels downhill. Well, same thing happens in business, right? Well, if there's a domino effect, right, then if the people who are doing the trades that allow me to lock in the profit that allows me to honor this commitment to the consumer, if they're going to incur more cost because the consumer changed up their original agreement, which the original agreement was we're going to close by this date. Nope, now we need 15 more days. Well, all of those costs you're incurring are going to be pushed downhill to get back to the end user. No different than if I buy something online, I pay for shipping, right? Because that person hasn't built shipping into their profit model. Now, if they offer free shipping, a la Amazon, they've built it into their profit margin. It's not free. It's just I'm paying a little bit extra so that I'm not being dinged for shipping. Okay, that makes perfect sense. So that's why I can't just extend someone's interest rate willy-nilly without there being some kind of a fee incurred. But how come I can't just lower someone's rate if the market got better?
Yeah, so there's a whole school of thought here on like float downs,
Yes.
right? And so some folks have very sophisticated hedging strategies that allow them to do that, but it's not for the faint of heart.
Okay.
That's like the level 400 class in capital markets. But when the market moves down like that, you're still reshuffling your hedge, right? You've still said, okay, I locked this loan at the 6. It doesn't matter if the market's going down to a 5.5. Like, I still have to take my hedge, close out the position, and then put on a new position to account with my pipeline or my amount of locks that I have.
So what I heard there is, yeah, it's complicated.
Yeah,
right?
a little bit.
It's complicated. Like someone's Facebook relationship status. It's complicated, right? Like, yeah, it's a complicated relationship. It's not as simple as, oh, just click a button. All you have to do is just draft some new paperwork and click a button. Like, no, we have to go and undo a bunch of trades. We have to make new trades. When we do that, we're going to incur cost, maybe even lose some money. Therefore, most of us in the industry don't have this quote unquote float down. I know we do on construction loans, but that's a whole nother beast. And that's probably why a lot of lenders don't want to do construction loans, is because from a financial standpoint, they're risky.
Yeah, traditionally they're more expensive to hedge, right? The same example of, hey, I need a cost for like a 1 month extension on a lock. Imagine doing 9 months, right, or 12 months. So you do see some really interesting things from like a margin perspective that folks do, like taking some money up front to lock for a longer period of time. And that might seem like counterintuitive to like what other folks are doing, but it makes sense to the mortgage originator because you're asking to honor this bet for a very long period of time, and that can get really expensive.
Yeah, I think that's the best way to understand it. Is like the longer you push out an interest rate lock, the much more difficult, the less certain, and therefore the more expensive it becomes. It's why a lot of lenders will either shy away from construction lending, or if they do it, yes, there's upfront fees or there's higher interest rates, because there's this massive game that we're having to play, and it's not a 30 or 45 or 60-day game. We're talking about 270 days all the way out to 360 days that we're having to play. What are some of the more common questions that you all tend to get at Optimal Blue? Because, like, look, if y'all don't know Optimal Blue, I know Optimal Blue, or what we call affectionately OB, because when I was at Waterstone Mortgage for 16 years, like, OB was our go-to for most of that. I think if I really want to go back, we probably were Loan Sifter way back in the day. And then we graduated up into OB. I don't even know if Loan Sifter's still around.
It's still around.
It's still around. Okay.
Still has a, let's call it anywhere between 6,000 and 7,000 brokers on it every day.
Wow,
still
no way.
Still getting pricing from Loan Sifter. Yeah.
Yep. And so like we know it as a pricing engine, right? Obviously, if you're in cap markets, people use Optimal Blue not just for their pricing engine, which, by the way, we call it a PE, right? Mortgage industry loves their acronyms. So PE, pricing engine. But you all are actually doing hedging for hundreds, if not thousands, of mortgage companies out there that don't have their own secondary team.
Correct.
But they do want the ability to fund their own loans, deliver those loans in the secondary market. More than likely, at that standpoint, they're probably delegated with their underwriting. They're not non-del. So therefore, they're locking what we would then call, at that standpoint, they're locking mandatory instead of best efforts. That's geek stuff that really doesn't matter to the consumer, but it matters to those. But I think it's good to know that OB does more than just a pricing engine. Optimal Blue is a critical tech partner powering a huge chunk of the mortgage industry. If you're a loan officer, you have almost certainly priced and locked a loan through the Optimal Blue pricing engine, even if you haven't realized it. They're the company that helps every type of mortgage lender stay competitive, protect margins, and move fast to keep pace with the market. Optimal Blue connects the front-end pricing that you rely on in your day-to-day as a loan officer to the secondary market, making sure every loan is priced accurately and backed by real-time data, so lending operations operate profitably and competitively, so they can continue originating more loans to help more home buyers. Optimal Blue has been doing this for over 20 years, and they've never let up on their commitment to continuous innovation for the benefit of lenders and the borrowers they serve. Bottom line, Optimal Blue helps lenders win more deals and keep more profit and originate more loans for more home buyers. Check them out at optimalblue.com.
Correct. And I think the biggest thing to think about is this concept of a feedback loop. So the beginning of the feedback loop is loan officer to borrower.
Okay.
Right? And then it's loan officer to what program that they want to lock to, what investor they want to lock to. And then it's that investor or lender up to the capital markets, right? And then there's that feedback loop there as well. So you get like the investor demand all the way to the borrower demand. And Optimal Blue is in all these different pieces, kind of like spinning the demand along up the life cycle. So that's where we kind of play. And, folks know us as, like you said, PE, or some people call it PPE, product pricing, eligibility. And typically the use case is a loan officer says, hey, I'm working with a borrower. I know they live here. They want this house. They want to do this down payment. They type in all this information into our product, and it will spit out all of the, investors that will take that loan scenario effectively, right? But then once that loan's locked, that's where the hedging and trading part of the business comes in. And when the loan's funded and then it's sold in the capital markets or it's securitized into a mortgage-backed security, that's kind of where we stop in the process there. hopefully that's helpful context.
No, 100%. And by the way, home buyers out there, like I have plenty of friends or clients of mine that I coach over at T-Lop's Originator Coaching that they're willing to show their borrowers, hey, this is my pricing engine. Like these are the investors, these are the rates. You can see the red, you can see the green. You can actually pick your own interest rate. Loan officers, if you're not already doing that, you should. Like it builds a thing of trust and brings value to your consumer. Now, it is good to know, though, like not all lenders have the same mortgage rates.
Correct.
And this is interesting because at the end of the day, the sausage is really only made one way. Now, sure, you get some sausage that has like applewood flavoring and some that has a little bit more spice in it. But at the end of the day, it's sausage. Yet we have different rates on different days from one lender to the next. Can you briefly explain with your big brain and all of your experience, why is that?
Yeah, it basically comes down to the cost to originate, right? So, when you think about this, lender-specific margin, let's call it that, it comes down to, what they're paying for their buildings, what they're paying for their technology, what they're paying for the people that work for them, what their expectation of profit is as well. In some cases, they might be able to live with more or less, depending on what's going on. It's their kind of also their thumb on the scale from a capacity standpoint. Maybe they only have 2 or 3 processors and one of them's going on vacation. Well, they might raise margins to basically stem the tide of originations, right? Yeah. And then the inverse as well. We saw this during COVID where rates dropped so fast, but the mortgage rate that was offered to borrowers didn't necessarily correlate to a drop that you would see in like treasuries, for example. And so what happens there is that lenders will actually use it as a demand constraint. They'll widen or tighten the margin depending on what their opinion is on demand, right? Is there too much demand and we can't actually underwrite these things under the timing that we're betting that we can? Or should I like go hire more people and get more capacity here or there? That's kind of the calculus they have to think about.
Yeah, I think it's good to know supply and demand comes into play. Like right now, when there's not a whole lot of demand, at least not to what we're accustomed to, mm-hmm. then most of us are operating on much thinner profit margins. If demand were to spike, then we're operating on much larger profit margins. But then on top of that, you may have a business model that's more nimble than mine. Therefore, you can actually offer something cheaper than I can because your business model is more nimble.
Correct.
Or I may be willing to operate off a lower net profit than you are, at which point I may be able to go a little bit less expensive. And that's the main reason why, even though the sausage is made for the most part the same way, like we all borrow money from the same people, we all deliver to the same people, we're all following the same best practices for hedging and trading, you would think, oh, then everyone would have the same rate. It's like, no, just like, not every hotel has the same rate, although it's a place that offers me a bed and a shower and a door with a lock on it, and not every airline. Although they're just a bunch of metal tubes with big engines on them and wings, but different airlines have different fees to get me from Orlando to Austin, mm-hmm. regardless if they basically do the same exact thing. So I know we have to find a way to put a wrap on this. Answer this question for me, Mike Vough. What are some cool products that OB has for the originator?
Yeah, so this has been a big focus of ours this year, and the kind of the flagship product for us right now is a product called Capture for Originators. And what this allows originators to do is to look at their previously done deals or their book of business. In about 90 seconds, 3 clicks, it culminates with an offer to the borrower, a stylized presentation. So when there was that rate drop that we saw about 2 months ago, going from like 6 5/8, 6.5 down to about 6 1/8, mm-hmm. That actually unlocked a fair amount of people from a refi perspective, right? You think about loans that were locked in the 7s or close to 8, you see 6. That's green lights in my opinion. So what this allows folks, and I think it's important to understand where it was previously was you might be looking at loans in a spreadsheet. You might then go into your PPE and then price out 3 or 4 different scenarios, then take the results from that, stick it on a flyer, and then send it in an email. That's about 30 minutes, right? But now it's 3 clicks, 90 seconds, and you're able to send out a stylized email directly to your borrower, and you could do it in a way where it's also connected to the PPE, so there's no bait and switch. We see that there's other products out there that use like survey rates or their own indices, but this is actually something correlated to your pricing engine.
So my margin's already built in.
Exactly.
It's an actual rate that I know that I could deliver on.
The market might move a little bit,
correct.
but there's no
Yes.
there's no massive delta because you're using a placeholder rate versus your actual pricing model.
Yeah, and what's that called again?
Capture for originators.
Capture for originators, but you can only get that if your company is working with Optimal Blue.
Correct.
Right. So if you're on a different PPE, you either have to check with them to see if they have something like that, or you need to convince your boss and your owner, hey, we should maybe look at changing our PPE, our pricing engine, over to OB if this is a type of feature that you want on the originator side
Correct.
of things.
And I think rates are going to be kind of stagnant, but if they do drop, that's going to unlock a lot of refi potential for folks. And having a tool like that where you could reach out to 100 people in a day with just a couple clicks is very powerful in my opinion.
So that was going to be one of my last questions. Where do you foresee mortgage rates? So you and I are recording this. We're in Columbus, Ohio. You're in town because you are a vendor for Lower Mortgage, and Lower's having their big annual sales conference. So OB has their booth, and you got to come up and sponsor the event and get a booth. I'm here because I'm partnered with Lower, and they're paying me to be here, and I get to speak on stage once today and once again tomorrow. So that's pretty cool. Plus, you and I get to connect. Where are you seeing interest rates, not just in 2025, because we're at the end of 2025, end of 2026, beginning of 2027, where are you prognosticating mortgage rates to go?
I think they're going to be sideways.
Okay.
So I don't think there's much room to go lower right yet. But we have seen some interesting headlines about job loss recently, with a lot of corporate jobs being cut at some very large players, and maybe we're starting to see some of the AI impact at that level with the white collar worker. But we don't have any job numbers right now officially, so it's tough to tell.
Government shutdown.
Yes.
Plus the BLS was dismantled before the government shutdown, so you have a double whammy going on right there.
Double whammy there. And I generally think that we're probably not going to see sub 3% inflation, and that's where we're kind of sitting at right now. I think the Fed loosened monetary policy in the right way, but I don't think they could drop it materially. Right yet. So I think we're going to be kind of where we are right now. Now, that opens up some opportunities. OB was actually just quoted in the Wall Street Journal today about the uptick in ARMs.
Okay.
So we've actually seen quite a bit of an uptick in ARMs. About, go back in time, maybe 6 months ago, it was about 1.5% of the volume that we see. It's almost 10%.
No way.
Of the volume that we see right now.
So more people are going to adjustable rate mortgages. Does that also have to do with maybe the yield spread widening a little bit?
See, you're going to be a capital markets guy in your next life. Yes, the spread between what Dustin's referring to is the shape of the yield curve, right?
Yeah.
Which, so you look at what the 2% rate is, the 5%, 10%, and you graph it, and depending on how the shape of the curve, it's either inverted where the 2 is greater than the 10, or it's positive sloping where the 2 is less than the 10. Back in 22, it was negative. It was inverted the wrong way. The 2 was above the 10. But now we're actually at a point now where it's about 40 or 50 basis points between the 2 and the 10 year. So the 2% might be at 3.5, and then the 10 might be at 4.
Yeah. So if you are a borrower, a loan officer, or a realtor tuning in, right? So we have Mike Vough here, right? He's with one of the premier leading hedging pricing engine companies that specializes in mortgage. And he's here to tell you, amongst many things that we talked about today, he doesn't see mortgage rates really changing for the worse or for the better over the next 13, 14 months. So if we're sitting in the mid to low 6s, we're going to stay in the mid to low 6s. However, there are ways to get lower interest rates. You can look at an adjustable rate mortgage, 5, 7 years, even sometimes looking at a 10-year ARM is phenomenal. If you think about it, most of us don't keep the same mortgage for more than 7 years. We're either going to move homes, which means we have to sell one house, pay off that mortgage to buy another house, get a new mortgage. We're going to refinance. Or we're going to end up paying it off because that's where we are in life and we can afford to do so, right? So look at an ARM, and if not look at an ARM, look at doing some permanent buy downs. You can pay money up front. I just did an entire episode for the DO show. So the DO show is something that we drop once a week on our YouTube channel as well as on Spotify and Apple, and it's kind of the sister to the Loan Officer podcast. And on that, I actually did stop waiting for rates to come down, force rates to come down, and these are 3 or 4 different strategies. So y'all, talk to your loan officer, work with your realtor, get the seller to cover your closing costs, you can actually pay money up front, not your money, the seller's money, to buy that rate down from 6.25, maybe down to 5.5, or even 5 3/8. At which point you're saving $200 a month or $300 a month. Homeownership is more affordable. Because if you're sitting around waiting for rates to drop, Mike's like, yo, rates probably aren't going to drop anytime soon. But if it makes sense for you to purchase a home because of life events. So last 3 questions. One is, was there anything that we missed on today's episode that we didn't talk about?
Yeah, I think there's one other lending trend that I've been fascinated by is the rise in non-QM.
The rise in non-QM. Okay.
Yeah. So what a non-QM mortgage is basically, you have to understand what a QM mortgage is first. So a qualified mortgage, that's something that came out of Dodd-Frank. And those are the types of loans that Fannie and Freddie will actually guarantee, right? And when we say guarantee, that means that the end buyer of the loan, if you're delinquent or if you just stop making payments, Fannie and Freddie step in and actually make the payments on behalf of the borrower to the investor. So the investor's made whole. If you're a non-QM mortgage, there is no Fannie or Freddie Mac guarantee. So, and there's some rules around what is non-QM, what's not non-QM. It comes down to a couple things. One, it comes down to effectively just income verification. So you typically see, the QM rules are very beneficial or favorable to somebody who's a W-2 employee. Now, if you veer off that, you see the rise of the gig economy. You see Airbnb investors popping up everywhere.
Self-employed.
Yep. Foreign nationals, ITIN, things like that. You are kind of off the QM path and you're on the non-QM path. And we've actually seen that jump from about 2.5% 2 years ago to just about 10% as well. So just seeing a large change there.
Are you all hedging those trades as well?
We're starting to see folks dabble.
Okay, so when you're in the non-QM, the stuff we talked about today, right? And non-QM, guys, that's your DSCR, that's your bank statement, the I-10, the foreign national, maybe you could even say a fix and flip would be a non-QM type product. So we're not yet hedging those. So then if I'm a consumer or if I'm a loan originator, I'm a realtor who has a home buyer and that's the product they're using, is there anything for us to know because that loan's not being hedged?
Yeah, I mean, so right now, there's not the same deep liquid capital markets out there for non-QM loans. So what I would consider if I was a borrower is making there could be an opportunity where people stop buying those loans.
Yeah.
Right. There's not a Fannie or Freddie backstopping with the guarantee. So if there is some type of shock, let's say China invades Taiwan, or there's some flight to quality event,
unemployment skyrockets unexpectedly, the market tanks. Yes.
Some of those products.
In any liquidity crisis.
Yes, liquidity crises impact that type of loan before it would a QM loan.
Yeah.
So you might see some this happened during COVID, where some non-QM investors basically had to stop offering the product for a period of time because the market was so volatile.
Yeah. No, I think that's good to know, right? And in general, and was that what you're hoping to share on today's episode? Was just understanding that there are non-QM products, which most of us in the origination space, you'd have to be living under a rock. If you're not originating non-QM, you're probably missing out on at least a 15 to 20% uptick in your business. But I would say as a coach, if non-QM is 50% of your business, and I have a guy that I coach where it's 90% of his business, and he knows this. I'm like, hey, Adam, at any point, that rug can be pulled from underneath you because it's a less liquid. There's no secondary market for it. There's the minute the market that is purchasing these loans says they don't want it, there's no one else willing to purchase it. And as long as he knows that, because I'm a good coach and I shared it with him, that I've done my job.
Correct.
But was there anything more specific that you're hoping to get across on the non-QM aspect?
I just feel like we're starting to see some more adoption of it. And one of the things, an interesting trend that we've seen recently is, typically when you're in one of these PPEs, you typically choose non-conforming or conforming, and you go down a separate path. There are some areas where we're starting to see overlap. So you think of an agency investment property compared to a DSCR. We're starting to see that line get blurred a little bit, where you might have been I'm going to go down the agency path, but maybe a DSCR actually makes sense.
That would be freaking cool if I could actually run a scenario through Optimal Blue and I could actually see, do I want to go Fannie Freddie and mess around with those LLPAs, or do I just want to go DSCR and let me see how both of them are pricing against each other, and then inform my client on what's the best path to go. So is that technology you all have access to today, or something you foresee happening?
Something I foresee happening. We've heard some one-off cases of people kind of doing it a roundabout way in the system right now. But going forward, I think you'll see that line kind of blur even more.
So for today's lesson, today's episode, just understand a lot of what we talked about was like your standard Fannie, Freddie, FHA, VA, and this is how the mortgage world works, which, by the way, that's 80% of the loans being originated, right? They're conventional conforming, they're FHA, they're VA. We start talking about jumbo, we start talking about non-QM. You know, things start to change a little bit, but we all need to be aware that non-QM exists.
Correct.
All right, my last two questions then. What is one of your favorite books you've ever read? Like you mentioned the first two by Michael Lewis in the beginning when you were 17, but looking, now as a married guy, a dad, an executive, what's one of your go-to books that you recommend?
Yeah, I love the writer Ron Chernow.
Okay.
He does fantastic biographies.
Yes.
I'm in the middle of the Mark Twain one right now.
Okay.
He seemed like a pretty sad guy, but he's done some really good ones on J.P. Morgan. He's done a fantastic one on Alexander Hamilton.
I read that one. That's my trophy. That thing is my trophy. It sits on a mantle.
I mean, they're about 800 pages.
They are.
They could hurt somebody if you hit them with it.
Yes.
So I would probably go with the Hamilton one, but
okay.
That or George Washington. He did a fantastic George Washington biography that I really liked as well.
I'm gonna have to get into that. I purchased Master of the Senate, which is Lyndon B. Johnson's biography.
That one's really big too,
it's
right?
Huge. Yeah. I need to get into it. I keep on finding other books to read that are much shorter and smaller. But yeah, that one was recommended to me actually by a buddy of mine in DC who's a lobbyist.
Oh wow.
And he's like, dude, if you want to truly, and it all came about because I was being ageist. And I was complaining about all these old ass senators. He's like, read this book first before you go all in on like needing to have age limits for Congress people and senators. I'm like, interesting. So I bought it like a year ago. It's been sitting on the to-do list. All right, so yours is going to be read something by Chernow. They're going to be a biography. Your favorite is Hamilton. You're reading Mark Twain's, but George Washington's and J.P. Morgan's was really good as well.
They're all really good.
All right, you're a dad of 3. Your kids are all small, so you get the next 10, 15 years of really being a great coach and mentor to them. What is one piece of advice that you're going to make sure that you raise them understanding that you didn't have shared with you, taught to you in high school, taught to you in college, but you've learned it through the School of Hard Knocks? Like, what's one thing your kids are going to be raised knowing because you're their dad?
That's a fantastic question. I think, and this is maybe a little bit of like a era change. I would say it's okay to like ask for help.
Okay.
Like I think I was born in the 90s. I think it was like tough guy mentality, like get through your problems. But I think like going forward in life, and I think the world's changed a lot, but like what I would teach them is like raise your hand. Like you're not feeling great, you're having a tough time with something, or you want to talk about something, like there's support systems around you to help with that. And so what I want them to know is that like I as their father will always be there to support them, but like you have friends, you have cousins, you have your mother, you have grandparents. There's a whole system of people around you that want to help. So just raise your hand. Yeah,
we tell all of our members at the coaching community that we put on, being shy is expensive. Like don't be shy. Like being shy is expensive in sales because look, you have to get out there and network and ask for the business. But being shy is also not being willing to raise your hand and ask a question. So I love that piece of advice. All right. How do people find you? How open are you to being contacted? If people want to learn more about the secondary market, want to just connect with you, want to learn about how they can be a client of OB as well, how do they do that?
Yeah, the easiest way is to just find me on LinkedIn. I post on there quite a bit. Optimal Blue is a podcast I appear on as well. I speak on the conference circuit quite a bit. So find me on LinkedIn, send me a message. I'd be happy to interact with anybody and help answer any questions. Yep.
First name Mike, last name Vough, pronounced like the magazine, but not spelled the same exact way. Mike, thank you so much for taking the time out of today to come hang out with me, JC, and the rest of the TLOP community. Y'all, he's Mike Vough. I'm Dustin Owen. If you want to connect with me, I'm first name Dustin, last name Owen. I am all over LinkedIn, and I'm highly accessible. Follow me on Instagram at the Loan Officer Podcast. And I don't know if you've tuned in on Spotify or Apple, or if you're watching on YouTube. If you're tuned in on Spotify or Apple, make sure you go and subscribe to our YouTube channel because we have tons of additional content, free content on that YouTube channel. If you're on Spotify or Apple, give us a 5-star review. It helps us continue to get this type of content in front of more people who would enjoy it or appreciate it. And if you're looking for someone to come in and speak at your next mortgage conference or to do coaching for your mortgage team, look no further. Come check out what we're doing over at T-Lops Originator Coaching. Reach out to me or a member of my team. We'd love to have a conversation with you. He's Mike. I'm Dustin Owen. That's all the time we have for you today, but we do look forward to catching you on the next episode. Peace.